Welcome to The Explainer. Today, we are breaking down a hidden tax trap that costs student interns, well, thousands of dollars every single year. If you're a student and you have a summer job, this is the 2026 tax guide you absolutely have to see.
So picture this. You absolutely crushed your summer internship. You built your network, you got amazing experience, and you even earned some decent cash. Then, months down the line, a letter from the IRS shows up. And let me tell you, it is not a congratulations card.
This happens so often it's actually got a nickname, the Internship Audit. Now, that's not some official IRS term. It's just what we call it when the IRS's automated computer system, the AUR program, finds a mismatch. See, it compares what your employer reports, what your school sends in about scholarships, and what you report on your tax return. If those numbers don't line up, boom, the system automatically flags it and spits out a notice that says you owe more tax.
So how do you steer clear of this whole mess? Well, we're going to break it all down step by step. We'll start with the two biggest federal tax traps. That's the Standard Deduction and the Kiddie Tax. Then we'll look at how your pay gets classified, why state taxes can be such a nasty surprise, and we'll wrap it all up with a simple action plan to get it right. All right, let's get into it.
Okay, first up, let's get right to the heart of the problem and really understand the mechanics behind this audit trap.
At its core, you got to think of the IRS as just this giant data matching machine. It pulls in information from everywhere: W-2s from your job, 1098-T forms from your school, investment income, you name it. The problem usually starts with things like fellowship stipends, which sometimes don't get officially reported. If the income you put on your return doesn't perfectly match what the IRS computers are expecting to see, an alert gets triggered. It's not personal, it's just an algorithm doing its thing.
The first, and by far the most common reason students get caught in this net, is a basic misunderstanding of the standard deduction. You've probably seen this number floating around. For 2026, the standard deduction for a single person is a whopping $16,100. It is so easy to look at that and think, hey, my summer job paid way less than that, so I'm good. I don't even need to file. But that assumption is exactly where the trouble starts.
And here it is. This is the single most important question you have to answer. Can you be claimed as a dependent by your parents or your guardian? Because if that answer is yes, that big $16,100 number, it just doesn't apply to you.
If you can be claimed as a dependent, a completely different rulebook comes into play. It's all laid out in the Internal Revenue Code, Section 63C5. As you can see right here, your deduction is the greater of two amounts, either a flat $1,350 or your total earned income plus $450. And trust me, that word earned is the most important word in this entire conversation. Let's see why.
This slide just shows you how incredibly critical that distinction is. Look at the left side. You've got $8,000 in W-2 wages. That's earned income. So your deduction is that $8,000 plus $450 for a total of $8,450. Your deduction is bigger than your income, so your taxable income is zero. Easy enough. Now look to the right. Same $8,000, but this time it's from unearned sources like a scholarship or investments. Your earned income is zero, so your deduction gets stuck at that flat $1,350. And all of a sudden, you have more than $6,500 of taxable income. Same amount of money, totally different tax bill.
Okay, so now you see how unearned income can crush your deduction. Let's look at the second major trap it creates, the Kiddie Tax. Now, this rule from IRC Section 1G was really meant to stop wealthy parents from shifting investments to their kids to pay less tax, but it ends up catching a ton of students completely by surprise.
The Kiddie Tax only kicks in for unearned income, but here is the detail that trips everybody up. The official instructions for the Kiddie Tax form, which is Form 8615, are crystal clear. Taxable scholarships and fellowships that are not reported on a W-2, they count as unearned income. This is a massive, massive trap for students. So here's how the tax actually gets calculated for 2026. The first $1,350 of your unearned income is tax-free. That gets covered by your minimum standard deduction. The next $1,350 gets taxed at your rate, which is usually a low 10%. But here's the real killer. Anything above that $2,700 total gets taxed at your parents' highest tax rate. So that scholarship money you earned could suddenly be getting taxed at 24%, 32%, maybe even 37%.
So you're on the hook for this Kiddie Tax if all four of these conditions are met. But I want you to look closely at that last one. That is the big escape hatch. It's called the support test.
If your earned income, we're talking from a W-2 job, pays for more than half of your own living expenses for the year, the Kiddie Tax doesn't apply to you at all, even if you have a bunch of unearned income.
This brings us to a really pivotal distinction, one that affects both your standard deduction and the Kiddie Tax. Is the money you're getting a genuine fellowship stipend, or is it just a wage for a job you're doing?
The rule for this actually comes directly from a Supreme Court case, Bingler v. Johnson, and it created something called the primary benefit test. It all boils down to one simple question. Who is this work primarily benefiting? Is it you and your education, or is it the company that's paying you? If the work is mainly for your benefit, for your education, then it's a true fellowship. But if you're doing tasks that mostly benefit the company, the kind of work an employee would normally do, then it's a wage, and it belongs on a Form W-2. This classification is literally everything. W-2 wages count as earned income, which gives you a bigger standard deduction and helps you avoid the Kiddie Tax. A misclassified fellowship is unearned income, which does the exact opposite.
And, as if the federal rules weren't complicated enough, you also have to deal with state taxes. We're going to use California as a case study here, because frankly, its rules are notoriously aggressive, and they really highlight the risks.
This chart shows the state filing trap just perfectly. A student with, say, $8,000 in wages might have zero federal taxable income like we saw before. But look at the difference for California. Their standard deduction for a dependent is much, much lower, around $5,700 for 2026. Because their income is above that much smaller state threshold, they are legally required to file a California tax return, and they're probably going to owe some money.
It gets even more complex if you work in a different state. Imagine you're a California resident, but you're interning in New York. New York is going to tax you because that's where you earn the money. But California is also going to tax you because residents are taxed on all their income no matter where they earn it. To avoid getting taxed twice on the same dollars, you have to file a non-resident return in New York, then file your resident return in California, and use a special form called Schedule S to get a credit for the taxes you already paid in New York.
Okay, so we have successfully navigated the minefield. Now, let's give you the essential toolkit for filing correctly and avoiding that dreaded letter from the IRS.
Here is your action plan. First, before you do anything else, figure out your dependency status. Second, understand how your income is classified. Is it earned or unearned? Third, check if the Kiddie Tax applies to you. Fourth, don't forget your state's rules. And finally, be smart about your withholding. Never just write exempt on your W-4 form unless you are absolutely certain you qualify.
Look, by understanding these key rules, the dependent standard deduction under IRC Section 63C5 and that primary benefit test from Bingler v. Johnson, you go from being a potential victim of the system to being in control. Knowing this stuff ahead of time is truly the best way to make sure your internship is a career boost and not a tax nightmare.
And all this leaves us with a final, bigger question. When the tax code is so complex that a student earning a modest summer income has to understand Supreme Court case law and multi-state tax rules, are we creating an unfair barrier for the very people we want to encourage to join the workforce? It's definitely something to think about.